Let me ask you something straight. If someone told you that you could collect $50,000 in rental income this year and legally owe nothing, zero, to the IRS, would you believe them? Most people wouldn't. Most people would assume that's some kind of loophole only the ultra-wealthy can access, something that requires a team of lawyers and offshore accounts. But here's what I want you to understand before we go any further. What I'm about to walk you through is completely legal. It's available to everyday landlords and retirees, and the IRS itself has written these rules into the tax code. You don't need to be rich to use them. You just need to know they exist. And that's the problem. Most people don't know. They get their rental checks, they report the income, they pay the tax, and they never stop to ask whether they had to. Today, we're going to fix that. I'm going to break this down into clear, practical sections. By the time we're done, you'll understand exactly which deductions and strategies work together to shelter rental income from federal taxes, how depreciation alone can wipe out tens of thousands in taxable income, what the passive activity rules mean for you as a retiree, and how the 2026 tax rules, including that new senior bonus deduction, fit into all of this. Stay with me through each section because these strategies build on each other. Miss one piece and the picture isn't complete. When you earn rental income, the IRS doesn't tax your gross rent. They tax your net rental income, meaning what's left after you subtract your allowable expenses. This sounds simple, and in principle it is. But the list of what counts as an allowable expense is much longer than most landlords realize, and the dollar amounts involved are significant. Here's a quick example. Suppose you collected $50,000 in rent last year from one or two properties. Before you even get to the advanced strategies, you have ordinary deductions available to every landlord. Mortgage interest on rental property is fully deductible. Property taxes are deductible. Insurance premiums are deductible. Property management fees, repairs, maintenance, advertising for tenants, professional fees paid to your accountant or attorney, all deductible. If you drove to the property to handle repairs or inspections, those mileage costs are deductible at the IRS standard rate. Add those up on a property with a mortgage, and you might already be looking at $15,000 to $20,000 in deductions without doing anything unusual. But this is just the foundation. What really moves the number towards zero is depreciation. Depreciation is the most powerful tool you're probably underusing. This is the part of the tax code that surprises people most when they finally understand it. The IRS allows you to deduct the cost of your rental property, the building, not the land, over a period of 27.5 years. This is called depreciation, and it's a paper deduction. You don't actually spend any money to claim it. You're simply accounting for the theoretical wear and tear on the structure over time. Here's what that looks like in practice. Say you purchased a rental property for $300,000. You and your accountant determined that the building itself, separate from the land, is worth $220,000. Divide that by 27.5 years, and you get a depreciation deduction of roughly $8,000 every single year. That's $8,000 subtracted from your taxable rental income every year, and you didn't write a single check to claim it. Now combine that with your regular expenses. If your mortgage interest, property taxes, insurance, and maintenance total $20,000, and your depreciation adds another $8,000, you're already at $28,000 in deductions against $50,000 in income. Your taxable rental income just dropped to $22,000, and we haven't talked about the more advanced strategies yet. If you're not sure whether your current accountant is maximizing your depreciation deduction, that's worth a direct conversation. Ask them specifically whether they performed a cost segregation study on your property, because that leads us to the next strategy. Cost segregation can accelerate your deductions dramatically. A standard depreciation calculation treats your entire building as a single asset depreciating over 27.5 years. But a cost segregation study breaks the property down into its individual components: flooring, electrical systems, plumbing fixtures, landscaping, parking areas, and identifies which components can be depreciated over a much shorter period, typically 5, 7, or 15 years. The result is that instead of spreading your deductions evenly over nearly 3 decades, you front-load a much larger deduction in the early years of ownership. On a property worth $200,000 in depreciable assets, a cost segregation study might move $60,000 of that into shorter depreciation categories, generating deductions 2 to 3 times larger in years 1 through 5 than a standard calculation would produce. For retirees who own rental property and need to reduce taxable income now, not 15 years from now, This acceleration makes a real and immediate difference. The cost segregation study itself typically costs between $3,000 and $10,000 depending on property complexity, but it's a deductible expense, and the tax savings it generates typically exceed the cost many times over. This is not a gray area of the tax code. The IRS explicitly permits cost segregation. Thousands of property owners use it every year. If you've owned rental property for more than a couple of years and have never had a cost segregation analysis done, you may be able to file amended returns and claim the deductions you missed retroactively. The passive activity rules and why retirees have an advantage. Here's where the situation gets particularly interesting for retirees specifically. The IRS classifies rental income as passive income in most cases, and rental losses, when your deductions exceed your income, as passive losses. Under normal passive activity rules, you can only use passive losses to offset passive income. You cannot use rental property losses to reduce your wages or Social Security income. However, there are two important exceptions that retirees frequently qualify for. The first is the $25,000 rental loss allowance. If you actively participate in managing your rental property, meaning you make management decisions, approve tenants, decide on repairs, and your adjusted gross income is below $100,000, you can deduct up to $25,000 in rental losses against your ordinary income each year. This allowance phases out between $100,000 and $150,000 of income and disappears entirely above that threshold. For many retirees living primarily on Social Security and some investment income, adjusted gross income below $100,000 is very common. If that describes your situation, this exception is enormously valuable. It means a rental property operating at a paper loss, thanks largely to depreciation, can actually reduce your tax bill on other income sources too. The second exception is real estate professional status. If you spend more than 750 hours per year materially participating in real estate activities, and that represents more than half of your total working time, you qualify as a real estate professional under IRS rules. This removes the passive activity limitation entirely, allowing unlimited rental losses to offset any type of income. For retirees who are no longer working a traditional job, meeting the time requirements for real estate professional status is more achievable than it sounds. Managing multiple properties, performing your own repairs, handling tenant relations. These activities can add up to 750 hours, and because retirement often means no other significant professional activity, satisfying the more than 50% test is realistic. Consult a tax professional to determine whether this status applies to your specific situation. The 2026 senior bonus deduction changes the math further. In addition to everything we've covered, the tax rules for 2026 include a provision that specifically benefits older Americans. Taxpayers who are 65 or older receive an additional standard deduction amount. For 2026, that additional amount is approximately $2,000 for single filers and $4,000 for married couples filing jointly. On top of the standard deduction itself, this is meaningful. But here's where it interacts with rental property in an interesting way. When your rental deductions reduce your net rental income significantly, your overall adjusted gross income drops. A lower adjusted gross income keeps you in lower tax brackets, potentially affects how much of your Social Security benefits are taxable, and may qualify you for credits and programs tied to income thresholds. Every dollar you legitimately deduct from rental income isn't just reducing tax on that income. It's potentially reducing taxes across your entire financial picture. There's also the Qualified Business Income Deduction, often called the QBI deduction, or Section 199A, which allows certain pass-through business owners to deduct up to 20% of their qualified business income. Whether rental income qualifies for this deduction depends on the level of activity and whether the rental rises to the level of a trade or business under IRS guidelines. This is an area where professional guidance is genuinely important because the rules have nuances that affect whether your specific rental situation qualifies. But for those who do qualify, the QBI deduction can represent an additional $10,000 deduction on $50,000 of rental income. Putting it all together, how the numbers actually reach zero. Let me show you how these pieces combine on a realistic example. Assume you're a 67-year-old retiree who owns 2 rental properties generating $50,000 in annual rent. Your regular operating expenses, mortgage interest, property taxes, insurance, maintenance, management fees, total $18,000. Depreciation on both properties adds another $14,000. A cost segregation study in a prior year shifted some assets to shorter depreciation schedules, so you're capturing deductions faster. Your net rental income after these deductions is $18,000. You qualify as an active participant in managing the properties, and your adjusted gross income is below $100,000, so the rental loss allowance applies if you need it. Your QBI deduction, if applicable, could reduce that $18,000 further by up to 20%, approximately $3,600, bringing your taxable rental income to roughly $14,400. Now layer on your overall tax situation. At that income level, after the standard deduction plus the senior bonus deduction, many retirees find themselves in the 10 or 12% bracket at most, and some find their total taxable income reaches zero or near zero when all sources are considered together. This isn't a magic trick. It's arithmetic using deductions the IRS built into the law. The variable is knowledge, knowing these deductions exist, knowing how to document them properly, and working with a tax professional who understands rental property specifically. What you should do right now. The most important step is a conversation with a CPA or enrolled agent who specializes in real estate taxation. Not every accountant is equally familiar with cost segregation, real estate professional status, or the QBI deduction as it applies to rental activity. When you speak with a tax professional, ask these specific questions. Are we maximizing our depreciation using cost segregation? Do I qualify for the $25,000 rental loss allowance based on my adjusted gross income? Does my level of rental activity qualify for the QBI deduction? Am I documenting my hours and activities in case the IRS questions my passive activity treatment? If you want to find the IRS's own guidance on these topics, Publication 527 covers residential rental property in detail. It's available free at irs.gov and walks through depreciation, expense deductions, and passive activity rules in plain language. Publication 925 covers passive activity rules specifically. These are the source documents, official IRS publications that lay out exactly what the rules are and how they apply. Also make sure your records are solid. Keep receipts for every repair, every professional fee, every insurance payment. Log your mileage to and from the property. Document the hours you spend on management activities throughout the year. Good record keeping is what turns allowable deductions into actual deductions, ones that survive scrutiny if you're ever audited. The bigger picture for retirees who own property. Rental property, managed with attention to tax strategy, can be one of the most tax-efficient income sources available to retirees. Social Security benefits are taxable above certain income thresholds. Retirement account distributions are taxed as ordinary income, but rental income, offset by depreciation and legitimate operating expenses, can generate substantial cash flow while triggering little or no federal tax liability. The people who pay the most taxes on rental income are generally the people who don't know what they're entitled to deduct. They report gross rent, subtract only the obvious expenses, and write a check to the IRS for the rest. The people who pay the least, legally, are the ones who understand that the tax code contains deliberate provisions encouraging real estate investment and who structure their record-keeping and professional relationships to take full advantage. You earned this income. You maintain these properties. You deal with tenants and repairs and vacancies. The deductions available to you aren't favors from the government. They're acknowledgement that running rental property involves real costs, real time, and real risk. Claiming every deduction you're legally entitled to isn't aggressive tax avoidance. It's responsible financial management. If this video gave you a clearer picture of how rental property taxation actually works, share it with someone else who owns rental property and might be overpaying. And if you have specific questions about your situation, drop them in the comments. I read through them, and they often become the basis for future videos covering exactly the scenarios real people are navigating. The rules are on your side if you know how to use them. Now you do.